Okay, I believe we are live. So welcome to our first ever SDC town hall meeting. And we're going to cover COVID-19 and all the effects that have happened leading up to it, and the after effects of what's coming out of it as we're still dealing with this virus here, not just in the United States, but obviously around the world. So with us, you have your SDC advisors. I'm Brent Shimon. We have Frank Dobnikar and Jason Rep, and then we asked two special guests to be with us today, and I'll let them introduce themselves. We have Kevin Simpson from CPA Web Books, and we have Nick Rach from the Earnings Scout.
Hello, everyone. Okay,
so with that, Frank is going to get us started here. And again, a couple of disclaimers here before we get going. None of us are Zoom experts, and this is the first webinar we've done, so bear with us if we run into any technology issues. From a compliance standpoint, S&D Capital, CPA Web Books, the Earnings Scout, none of us are affiliated. This is to be provided as general information. Advisors for specific information as regards to your specific scenario. And Cambridge Investment Research is our broker-dealer, and that is not affiliated with any of S&D Capital, CPA Web Books, or the Earnings Scouts. Okay, so we are going to kick us off here with a poll. We've got a lot of the attendees signing on, and we encourage you to answer the questions so we can get some feedback. Everybody's thinking through this. So your first poll question here: have you or do you personally know someone that has tested positive and actually tested positive, not someone who believes that they have had COVID-19? So we'll let this run for about 30 seconds, 45 seconds until we see most of them in, and we'll see what the results are coming out of this. Okay, so we've got almost 75% in on the poll, and so 54% do not know someone that has actually tested positive, and 45% have. So right about in the middle, which, you know, we didn't know kind of the answer or where that would have gone with that, but that's pretty much basically a 50-50 split from our sample that we have here on this panel.
Yeah, a couple of notes on the polls. These are anonymous polls, so we're not keeping track. We don't know what you vote. So play along with us here. I think we got another second poll question to run, don't we, Brent?
We do. Frank, you can take this one away.
All right. So stay-at-home orders. Everybody's starting to slowly get back. So the question here is, to what degree have you been following the stay-at-home orders? We've seen people from around the country following it to a T, and some so-so. So we're curious to see how our attendees are following stay-at-home orders. We know that Ohio's done a really good job at it, but curious to see how our attendees have been following stay-at-home orders.
We'll give it another 10 seconds or so here, but okay, so we have almost 80% in here, and oddly enough, we have another 50-50 split. So half of you are 100% only leaving for absolute necessities, and half of you are somewhat, we visited family and friends. Whether anybody would be embarrassed, but there was nobody for the third option of visiting family and friends as we were before, and nobody for the business as usual in my house. So again, 50-50 split. And I think that's the consensus as we talk to clients throughout the last month. It seems to be that pretty much everybody's following it, but it's been interesting for the clients that are in other states where we've seen dramatic differences in how Ohio's handled this versus some of the other states. Okay. Okay, so this is how the format's going to work today. Introductions, poll questions. Frank's going to talk about some planning opportunities. Kevin's going to go into some tax update. Nick from the Earnings Scout is here to give us a market update. And then I'll finish with some of the psychology of what's taking place through this. And by no means am I a licensed psychologist. And then there's Q&A. We've had some questions come in before this that we'll cover, but you're welcome to submit them through the Zoom app as well.
All right, thanks for going over the agenda, Brent. We're going to give you a lot of quality information here, some action items, and hope you get some good takeaways, and it's worth your time. So grab a beverage, and let's get started here. So I know a lot of people have been doing a lot of these webinars and Zoom calls here over the last 6 or 8 weeks. So again, thanks for joining us. You are going to hear, some technical terms, and we're going to try to simplify the jargon a little bit for you. But if you write down your questions, follow up with us, and we'd be happy to explain it to you in more detail. So, back to the basics here. A lot of what this kind of reminds us of is, just getting back to the fundamentals of investing. And most of our clients have been fantastic through this time period and not overreacting. But since early to mid-March, it seems like years ago now at this point, coming in here at the end of April. But patience and removing the emotion, it's easy to say, but it really is hard to do, especially when you're in the midst of markets falling, businesses closing, the virus spreading, medical questions, and not having a lot of answers. So, it's just a good reminder, have patience, try to remove the emotion, work with your advisors, and, kind of going into the second point there is focus on your long-term goals. We've all heard that, we know that, let's not focus on the day-to-day, but more the longer-term trends and the goals. So we're most concerned with, successful outcomes for our clients, and it's hard to focus on those goals, but we try to bring everybody back to what's the ultimate outcome that we're trying to achieve here. This is a great time right now to be reviewing your plan and, taking a look at what you're doing. So prudent financial planning. This is why you have an emergency fund. This is why you have low or no debt, and why a lot of our clients have been pretty calm through this, following these prudent financial planning rules. So the risk tolerance, we've been working with our clients for forever, and really focusing on their risk tolerance here over the last 5 years, and making sure that your risk that you're taking in your portfolio is balanced with what you're comfortable with market volatility. So, we've had a lot of, big market swings here. So risk tolerance is definitely something you need to be reviewing on an ongoing basis. So, and the last kind of basic is, diversified asset allocation and your income strategy, making sure that you're reviewing your withdrawal rates if you're taking distributions and withdrawals from your portfolios, and reviewing your income strategy plan. So, a lot of our clients have a conservative bucket of money, and a lot of them are taking some money from the conservative allocation at this time while markets rebound. We're going to jump into a couple of planning opportunities here. These are some good takeaways, and just make sure that it fits with your specific goals and plans. So, tax deadline and the IRA deadline have been moved to July 15th. So if you do have extra savings, your income's stable, you want to make your IRA, traditional IRA, Roth IRA contributions, you still have up until July 15th this year to make them for prior year contributions for 2019. So that's something to take a look at. RMDs, that second point, required minimum distributions have been suspended for 2020. So for those clients that are you know, 72 and older. And I say 72 because the Secure Act that was just recently passed last year moved the required minimum distribution age up to, say, age 72. But now they've suspended, and you do not have to take your distribution if you don't want it. So, of course, you can take it. A lot of our clients are suspending or not taking it, and that'll allow you to defer that income tax until you need to take it out the next year. You know, the following year, it's not really going to change the calculation going forward, other than you're not going to have to take a double distribution. You're just going to have to restart RMDs come 2021. With interest rates and you know, moving dramatically lower, this might be a good time for you to take a look at a mortgage refinance or restructure some of your debt if you have any. That might provide some monthly savings for you, or cut the term of your loan down. So we have a lot of clients that are currently looking at those options. For our IRA conversions, for this opportunity, you know, if you did have a loss of income or your income has significantly gone down this year, this might be a great time to look at converting some of your, some or a portion of your IRA to a Roth. There's definitely some more variables that you got to consider before doing that, but that's something to take a look at. Consolidating old plans. So a lot of our clients have, you know, former employer 401ks or 457 plans, 403bs that are hanging out there. This is a great time to be looking at consolidating all those. The extreme volatility that we saw in March has somewhat slowed and subsided. We had a nice rally day today, but now is a great time to consolidate those plans, get them under control, and upgrade and reposition how those plans are and accounts are invested. You know, dollar cost averaging. This is, you know, tried and true method through, you know, market volatility. Assuming your income is stable, you're comfortable with your emergency fund, you need to continue to invest during this market volatility. You know, buying more shares when the prices are lower with the idea that markets will rebound. So hopefully you've been doing that, and that's a great way to long-term, you know, make money in the markets. Estate planning updates. We've had several clients, you know, over our conversations of the last 6 to 8 weeks that have, this has jump-started them to review their power of attorney, their will, their trust, beneficiary review. With, you know, people getting sick and some uncertainty out there, it's kind of been a catalyst for reviewing some of those things. So great time to be doing that. And believe it or not, term life insurance. We've had several clients, even through this pandemic, that have applied and gotten new term life insurance. So, you know, if you're in good health, there's, you know, e-application process and some even accelerated underwriting where you might not even have to take a paramed exam. But we've had several clients get new policies and get those in place here over the last couple of weeks. So those are some good takeaways, some things to be considering for your personal plan. If you have questions, please follow up with us. But I'm going to, I do have one more slide here to talk a little bit about if you have been off of work or lost your job. The CARES Act, which Kevin will talk in a lot more detail, but made some provisions for retirement distributions and loans. So coronavirus-related distributions up to $100,000 or 100% of your vested account balance can be taken from your retirement account should you need it. And really, we look at that as kind of the last resort if you do need some help and do need some liquidity or some funds during this time. So there's a couple of bullet points there. You got to self-certify that you've been financially impacted. For individuals under age 59 and a half, the premature 10% distribution penalty will be waived. And then here's kind of the big thing, the federal income tax. You still will have to pay income tax on it, but you can spread it over 3 years. The other nice thing that if you do need to do this, you can repay some of that distribution or all of it over the next 3 years as well. Again, you may have to amend some prior year's tax returns, but those are some ways that if you did need to access the retirement funds, that the CARES Act has allowed for some options and some tax relief. So check with your plan and your custodian of the accounts before you do this. You know, they're still waiting for some guidance from the IRS and the Treasury, and they're still updating their forms and processes to be able to help people with these distribution and loans.
Okay, thanks Frank for that. We're going to go to another poll question here. So we're going to talk about, there's 2 questions here actually, so make sure you answer them both. But changes in your behavior as a result of COVID-19. And so the first one is, what effect will this have on your behavior when it comes to online experiences? So how much more, we're all trapped in our houses, how much more are you, taking the online experience, so even when the store is open, I still plan to stay online. I'm ready to get back to traditional shopping, exclusively shop online, avoid entering a store when possible. Once the economy reopens, I don't expect any changes. And we expect this one to maybe be a little more across the board. But again, if you're on here, just please take the time so we can get a good sample of kind of where everybody's at. Second question is, have you embraced new technology as a result of COVID-19? I've got some clients that have never had email that now have email that I've talked to. And if you're on here, I commend you. So, I think this is all changing the way we look at things and how we're doing it. And we're seeing, grandparents downloading Zoom and using FaceTime because they haven't seen grandchildren in weeks. And so, I think when you kind of look at it from that standpoint, we've all had to embrace it to some degree. Otherwise you'd be kind of cut off from the world entirely. We try to do a really good job with clients that we know are alone and making sure that we're reaching out to them and asking if they just need anything in general. Maybe they're a widow and don't have family in the area type scenario. And I think that's just what the world's come to, right? We're all embracing a new normal and we don't know exactly what that looks like on the other side. Okay, so we got a good sample here, so I'm going to end the poll. The first one, we've got 31%. When the stores reopen, I plan to shop more online. 24% to go back to normal. 10% to exclusively shop online. And the winner is 35%. Once the economy reopens, I don't expect any changes in my behavior. So that's about a third there. The second question, have you embraced new technology? 43% absolutely. 33% I added video conferencing so I can see my family and friends. 2% not really, technology isn't my preference, but I commend you for being on here if technology is not your preference. And 22% no changes in my behavior when it comes to technology. So you can see the results there too. I figured this out how to share them there. So again, kind of just to give you a sample, depending upon what camp you're in, you can kind of see that there is a percent where this one's kind of more split across the board on how we come out of this, because that's the real dance of once things open, who does what and when and what the comfort level is as the economy starts to recover. Okay, so next up, I'm going to turn it over to Kevin Simpson from CPA Web Books. He's a local CPA, does a lot of payroll for small businesses, so he's been right in the throes of this, helping his clients get things that have been passed along the way. And Kevin, I'm going to give you control and take it away.
All right, excellent. Can you hear me all right?
Yep.
So there's 4 acts passed by Congress. You've probably heard of most of them in the news. I just did a little summary sheet here. The first one, really tiny, not a lot of activity there. Second one is one that's still being fleshed out, even though it's been passed almost a month ago. It provides sick pay leave. So it's a small package, but it's very helpful. And the third one is a huge coronavirus package called CARES Act, $2.2 trillion or 2,200 billion. And then there's a bailout of the bailout because the third one wasn't big enough. So we've got more funding that was passed last Friday. Let's see, next on our, let's see here. Oh. Be able to advance me to the next screen or next tab? Slide.
Hold on a second here. I was in the chat function. I got to take control back from you.
All right.
Actually, you have to give it. Oh, no, I can get it back, I think. There you go. I'll keep control, Kevin. You can go.
All right, perfect. So yeah, this tab just shows some of the details related to the Family First Act, and you might not be that familiar with it. It's really quite helpful, but essentially, government's going to cover nearly dollar for dollar reimbursement of sick pay. So they're requiring small businesses to pay these out, and they're going to be covering that through payroll credits. So up to $10,000 per employee is available. Go ahead and switch. There we go. And this third act is the big one. Everybody's been talking about it. This includes the economic impact payments or the stimulus checks that everybody's been getting in the last 2 weeks or hoping to get. Those go to individuals. Then that second item is the economic injury disaster loan. And that's one that small businesses have been applying for, but really it's for anybody who's a contractor. Even if you don't have employees or anything, you can apply for that loan. It's really slow in the rollout. It's a direct application straight to the SBA online, but we've really seen only a couple actual loan apps come out where the SBA is offering those loans. So it's taking a long time for them to process a ton of applications. But there was an advance that was tied to that you probably heard about. And then the third one, the employee retention credit, is another way for Congress or to basically fund your payroll on a small business payroll if you had a 50% drop in revenue. So a lot of the businesses that have been forced shut based on the quarantine requirements, they might be able to take advantage of this. However, that fourth one, letter D, that payroll protection program is the biggest, by far the biggest. And it is, a program you can participate in if you don't do the employee retention credit. So it's one or the other, and we'll talk more about that one. And the fifth one here is also very important, and maybe you haven't heard a whole lot on that, but the unemployment insurance that's been enhanced by the Fed. That's got some substantial benefits that a lot of people locally are taking advantage of. Let's go ahead and flip. All right, so the economic impact payments, stimulus checks, they've been going out direct deposit based on your last tax return filed. So if the last one was 18, they grab the data from there. If you've already filed your 19, then they send it there. And it's assuming you've got your bank information included on those tax returns. If not, they might be trying to mail you a check. We've been receiving reports that the mailed checks are starting to arrive now. And then a lot of the questions have been, how do I get my bank information to IRS? If they don't have it, can I get it to them? And really the best way is to file a tax return. There were a couple other scenarios that were supposed to pan out and they never really got developed. Like a portal that IRS was supposed to put together and they never did. So anyways, the 2020 return is ultimately what is going to be used to reconcile these payments. So they're going to send them out based on the last information they've got. But it's your 2020 return that will say, hey, if you didn't get the check and you deserve it based on your 2020 return, great, we'll give you the credit on your 2020 tax return. That's what we're filing, next year. So don't worry if for some reason you think you're eligible and didn't get it. The 2020 return is kind of the catch-all for that. And also don't worry if you qualify for the stimulus money on one of the old returns and then you find out you don't qualify based on your 2020. Don't worry, you don't have to pay it back. There's no clawback provision. So the money that goes out stays out. And I don't think in any circumstance they're going to try and recollect that. And that's different than the past stimulus checks in like back in the early 2000s. One note that people have been asking about a lot is the high schoolers, that are over the age of 16 or college students. These children that are really dependent on a parent's tax return, they are not eligible for the $500 child tax payment, and they're also not eligible as adults. They really don't get any funding attached to them. The only way around that is if your child decides to file a tax return and not be a dependent on the parent return. But we advise against that in many cases tax-wise. You might lose out on some education credits if you did that as parents. So generally speaking, you just kind of let it go as is.
So a fun tidbit here for the audience, Kevin.
What's that?
Kevin, how many children do you have under the act that you got? I forget what number you're up to.
We've got 11 total, but I'd say I think 3 or 4 of them are missing the mark right now. 3 of them are.
I just thought I'd share that with everybody because I know you love the big family.
Yeah, there's a heartache there, because they're more expensive when they're older, and nobody understands why they're excluded from this program. So it's just that they followed the child tax credit method, and that's what's always been in place through that. Let's go ahead and do the next slide. Okay, the economic injury disaster loan, I mentioned this earlier. They did these advance checks. So if you applied, it was a 2-page application online through the SBA website, you could get up to $1,000 per employee, or up to $10,000 max. And even if you don't have employees, you would have qualified for $1,000. And they were just sending this money out direct deposit. That's all mostly been done, and that app is no longer available on the SBA site. Last week, they did refund it with another $50 billion. The initial funding was only $10 billion, but that app has not reappeared. They're still showing it as down. So if you haven't applied for that, and even if you're an independent contractor, that's something to look at. It's real easy to do. It might take you 15 minutes. And then, these types of loans are great because there's no guarantee requirement, there's no collateral requirement if it's a small loan. If you need a bigger loan, there's options there too, but you might have some collateral issues. And they're coming out with these 30-year terms, 3.75%. They're gonna have to pay on it for 6 months. This is a good working capital solution for small business. Let's go to the next one. The employee retention credit. We've not had any clients participate in this yet. I'm curious if at some point it'll make sense. If you didn't get into the payroll protection program process, then this would be a good option, but you cannot do both. So this is worth looking into in depth, and it would require some additional consulting and examination of your employee levels and your revenue levels and what you predict for your revenue for the next few months ahead as far as the small business goes. Let's go to the next one. Okay, the PPP, this is the Payroll Protection Program. This is the big one. Everybody's been talking about it in the news. This thing ran out of funding in 2 weeks. $349 billion was just instantly evaporated. And really it went faster even this week. There's a refunding of it that was signed into law last week. So there's like another $320 billion that was put in the program. And the refiling, or the new filing started last Monday at 10:30, and all kinds of hiccups, but it seems to be running okay. We've got reports from a lot of local banks that have done well in processing these things. So this is a loan that's essentially 2.5 times your average monthly payroll. And the big kicker is if you use it for payroll and you use it for rent and utilities, and you use it all within the first 8 weeks after receiving the money, essentially it's all forgiven. There's a process to go through to get the debt forgiven, but it shouldn't be too bad. You have to work with your bank to submit documents to prove that. But just show that you paid the money and those types of expenses, and you can theoretically get it all forgiven. So very, very popular and very helpful. Let's go to the next one. So this is just
Kevin, if I may jump in there real quick. We've talked to a number of clients this week, small business, that are actually starting to get the SBA numbers this round. I did talk to a commercial banker today, and they believe it will run out of funds again by the weekend. I can't say that that's validated, but that was from a local commercial lender that I spoke with this afternoon, and he believed that it will run out again this weekend, which is just mind-blowing. So you may even see a round 3 come back for that.
Yep, and it's interesting, Congress was going to reconvene, I think starting Monday, and they've canceled that. But that doesn't mean they can't pass more funding later if they need to. So we'll watch that, because we've got a lot of clients that have been, maybe didn't jump on it right away, and then the banks stopped taking applications, and then at other points they would reopen and take apps. But everybody's been swamped and doing their best to process.
And we've been seeing a lot more success with clients at the smaller banks.
Yes.
No knock on the bigger banks, but we've seen a lot more success and speed of securing the funding in round 1 and round 2 with the local community banks as opposed to the bigger banks. And I don't know if that's a relation to size of loans, because you're seeing smaller PPPs, but we have not seen the bigger ones move nearly as fast as the small ones have been able to. Absolutely
the case, everything we've seen. So if you have a local bank connection, reach out to them. That's going to be your best bet. And it's partly because you just need somebody to talk to. You need somebody to have some interaction with and be able to get, a status update. The big banks aren't really communicating. Let's go to the next one real quick. All right, the expanded unemployment benefits, this is huge. So, when you think about the stimulus programs in general and what's being done for this downturn in the economy and all of these people that have lost their jobs, at least temporarily, there's a lot of money being pushed out in that direction. So this is a big one. If you're not able to participate in the payroll protection program, and your employer can't keep you on for whatever reason with those programs, then you're on your own as an individual. And you can apply for employment through your state. They're going to pay you maybe 50% of what you normally make. And the IRS or Congress, the Treasury, is going to be sending you an additional $600 a week added on your benefits. This is huge, very, very helpful. In many cases, if you're making 10 or 15 bucks an hour, you're getting paid more to stay at home than to work. That'll be a separate issue to deal with later. But there are a lot of opportunities here. Plus, it's now being applied to independent contractors and gig workers. So anybody is eligible for this, even if you haven't paid into the unemployment program. The state administers this, so you've got to go through the Ohio website to file for unemployment. And they've all got everything loaded up and running now to accommodate the contractors, which couldn't be done even a week ago. But that should be operational now. So it's a huge help for everybody.
Hey, Kevin, we've got a question here on the Q&A. I've received my EIDL grant for my business. How do I categorize this, and is it taxable? And how does it also apply when I receive the PPP loan?
Yeah, so no, it's not taxable, supposedly. We'll see how that shakes out. But that I assume he's referring to the actual advance, to the forgiven piece. And yes. So if you receive a $10,000 advance, it's going to be forgiven. If you go and apply for the PPP, there's also a forgiveness of debt portion there. The two cannot have the same dollars forgiven, so to speak. So essentially, the debt forgiveness value on the PPP will be reduced by the debt forgiven on the EIDL. So just keep that in mind. We have had some clients ask about that because they don't want the PPP to be turned into an actual loan. They're just working to get it forgiven. But remember, you're going to have that at least some of that balance of that PPP loan still there if you did get some debt forgiven through the EIDL advance. But don't worry about taxability on either one of those. They're specifically saying that that's not a taxable type of income, which normally would be the case. Debt forgiveness is generally taxable, but not in this case. Let's go ahead and do the next one. So this is already stuff that Frank talked about with retirement updates on the tax side, and we can go through the next one. These are really the tax updates that are left. There's not a lot. Almost all of the tax adjustments that have been included in these acts are very small. They're business focused. They're not relevant to most of us listening today. The one item that is a little bit at the very top there is the $300 of charitable contributions. So if you normally just take the standard deduction, you really don't get a benefit, so to speak, for your charitable contributions. This little notation says, yeah, we'll let you take at least $300 in addition to your standard deduction. And then employers are given some opportunity to delay the tax payments on the employer portion of the Social Security tax. So you can push it out almost up to 2 years, help with cash flow. That third one is net operating losses that are created in past years. There's a provision that we always had. You could always carry it back, and then they got rid of it, and now they brought it back. So now you can carry back your losses and maybe get some refunds if you had some profits in those past years to offset. The net operating loss limit of 80% is suspended. That's kind of a new thing, but at this point you can take your full operating loss and it doesn't get limited. And then there's this last one here, this other one with the 30% of EBITDA. There's a limitation to interest expense tied to your income, and that was bumped from 30% up to 50%. And then there's a technical correction. This is just related to some depreciation. When Congress last passed a law to give you qualified improvement property, and they said you could write it all off in the first year, and then they forgot to tell you that it could actually be seen as 15-year property, and so none of it was eligible for early write-offs. It was supposed to be. They fixed that, and we've literally been waiting for that fix for 2 years now. So that's nice to see. And then the excise tax, that's just a notation about if you use alcohol to make hand sanitizer, you don't have to pay some special tax on that. And then my last slide there. This is just to sum it up. I mean, the business help, it's in the loans for working capital. There's forgivable loans for payroll expense. There's employer credits for sick pay and family leave. So all the requirements put on the employers are also being really financed directly by the Treasury. And then for individuals, if the above loans don't help you keep your job, individuals still get the stimulus checks. And then there's also this boost in the unemployment benefits. So I know there's a lot of people that fall in the gaps. I know there's a lot of people hurting, and these programs aren't helping. Sometimes it's because they don't know about them and they don't know how to navigate the system. Other times just because they did the best they could to reach as many people as they could. And anyways, it's actually pretty amazing what they've done. If you think about $2.2 trillion, and if you stack that on top of each other in terms of dollar bills, I think you could practically reach the moon with it. So it's tons and tons of money being flooded into the market in the midst of downturn. And like an anecdotal notation, I was driving through Chick-fil-A, drive-through at like 2 o'clock in the afternoon. Couldn't even get into the parking lot. I was so backed up, so much business. Talked to the owner there, and he said it was dead until the stimulus checks started showing up. So stimulus checks immediately bring people right back out. They're spending as they used to spend, and in this case, Chick-fil-A is benefiting from it, and as I think other businesses will too. So those checks go back out in the economy pretty quick. That's all I've got.
Okay, I'm going to jump in here with one poll question before we get into Nick. And some people had said that they weren't able to see them. So I'm not technically inclined enough with Zoom to tell you why you can't see it. I was trying to figure it out while Kevin was talking, and I don't see a setting for me to change it. So about 85% are voting. But when do you expect to resume your normal travel schedule? June, July, August, September, October, November, December or later, or this has changed my future plans and I don't expect to travel much? I give it about another 20 seconds here, kind of as it's coming in. Okay, we've got about this. So again, I apologize for those of you that can't see it, and I can't give you an answer as to why you can't see it. So I'm going to end the poll here, and it is June, July, which is a little surprising to me, but obviously in the optimistic camp, as the town hall is invested in optimism. So June, July at 36%. August, September, close behind at 25%, October, November, and a little bit of December or later. I've talked to a couple clients that have cruises booked in August and are completely comfortable with it. So I think you've got a varying degree, but to see the June, July to come out there with August, September followed closely behind it, that's why we're optimistic, and everybody on the panel, not just S&D Capital, that we do see a recovery, probably much quicker than what some of the so-called experts on the news channels are predicting or trying to sell fear to everybody that nothing is ever going to recover like it did before. So with that, I'm going to turn it over to Nick Rates from the Earnings Scout, and he has a long history of looking at earnings, and he will share his views on the markets and where we're at and where we're going. So Nick, go ahead.
Thanks, Brent. And if I can't control your screen, do you mind if I share my screen and I'll just have this presentation from my computer? So
I think I can. 1 second.
I think if I can. Oh.
So you got to go back to slideshow. It takes it out of slideshow. Go up top, and you can go from current slide.
Which is way, actually. How about there? How's that?
It's not taking it to. It's
not
not taking it
itself.
It's not taking it to its actual slideshow. Let me try it from my side here.
Okay.
How about that? Can you control the mouse now?
If you give me control, let's see. Doesn't seem to be wanting to go.
Okay, I'll do it from my side if you want. I think it's easier.
Okay. Or you can just click through here. I have animation, so it'll go through, so you have to click. You can click again. So this is Larry Kudlow. Click back. That's Larry Kudlow, and he's the National Economic Advisor to President Trump. If you know Kudlow and Kramer show, he had a CNBC show. He advised in the Reagan administration. He has a quote: "Profits are the mother's milk of stocks, and for that matter, business and the entire economy." So my whole career has been just entrenched in earnings analysis. And if you click forward, Brent, I've been doing the Earnings Scout since 2013, but I've really been tracking corporate earnings trends for the past 25 years. I began my career in the mid-90s in Zacks Investment Research in Chicago. I headed the investment team in Chicago there. And then in 2005, I moved to Cleveland and became the head of investment research for National City Bank until 2009 when it was taken under by PNC. And then I followed my chief investment officer over to KeyBank, where I was the head of investments until 2013, until opening the doors at Earnings Scout. So I really understand the relationship between earnings and stock prices. And the one thing that I think a lot of people get confused with, and this includes many investment professionals, is stocks are always going to trade off of what's going to happen, not what is currently happening. So we're always going to look forward and not back at future earnings, not current or past earnings. So if you click onto the next slide, you got Wayne Gretzky here, the great one. If you click one more time, Brent, he has a quote, and this is, well publicized, kind of cliche at some point, but he always said what made him great is, "I skate to where the puck is going, not to where it has been." And that's exactly what's going on with stocks every single day. If you are skating to where the puck currently is, you're going to miss out in the stock market. You have to predict and be smarter than the rest of the street and the collective brain power of Wall Street to know what's going to happen in the future and to whether or no those future expectations are too high or too low. So click again, Brent. So earnings and stock prices. So this is the stocks is measured by the S&P 500 down minus 12%. Well, we had a good day today, and this was updated as a couple of days ago. The S&P 500, this is crazy to me, is down 9% year to date. So let's think about that. We just shut the economy down. We're going to get data that's going to rival the Great Depression. We're starting to collect some of that data. We're going to get, during the Great Depression, the economy didn't shut down. It did shut down during the 1918 Spanish flu. But to think we're now only down 9% year to date after tonight's close. It's pretty remarkable if you think about that. If you think, if someone would have told me at the beginning of the year that my kids would not have school from mid-March to the remainder of the year going in, the NBA would suspend these and professional sports wouldn't be going on right now. All non-essential businesses would be closed, and the S&P 500 would only be down 9%. It's hard to believe. So if you click the next stat, click through a couple of these, Brent, we can go through these fairly quick. The S&P 500 is now up since March 23rd, 31% through tonight's close. And keep in mind, since March 23rd, all companies are literally reporting their worst earnings and worst earnings expectation cuts to their second quarter estimates since we measured we had to go back to 2009 to see this. And as more companies report, we really believe we're going to see the worst cuts I've ever measured in 25 years. At the same time, stock prices are rising. So a lot of people think stock prices have become disconnected. I'm going to show you where they're not. So Brett, you can click through several of these slides here. The animation starts here, so you can go through a bunch. And I just want to talk about Alligator Jaws and what we do at the Earnings Scout. If you notice what the circle up there says January 3rd, 2020. So what do we mean by January 3rd, 2020? This is the chart as of that time. The blue earnings scores that we have here is measuring the rate of change to earnings expectations. And if you look here, when you're above the line, the estimates are going up. When you're below them, they're going down. Now, Brent drew in two arrows there going down. That's showing the slope of the rate of change to the estimates. So in 2018, we had cuts. The corporate tax cuts went from 35% to 21%. So we had a big boost in earnings and earnings expectations. As that wore off and the expectations for the next year, they started to wane. All the while, the price went up. That's a negative divergence. So Brent, click one more time, and this is where we say it's an alligator jaw. It looks like an alligator jaw that opens. It's a divergence. You can't have this continue in perpetuity. If you go into business and what you think you're going to make keeps getting worse and worse, the value of your business should not be going up and up. Well, that's what was happening to stocks in late 2018. Now, when you have an alligator jaw, we know they always close, but it needs a trigger. So if you click through here, you could see there was a big drop in price, a 20% drop in price in late 2018. What was the trigger? One more click, Brent, you'll see it was the Fed. Jerome Powell and the Fed was raising interest rates too much in 2018, and they were killing earnings expectations. They were actually just crushing them, and the market sold off on that. So in 2019, the Fed changed its view, and instead of cutting rates, raising rates, they started cutting rates. And then if you click two more times, Brett, you'll see the earnings expectations started to improve, and price went with it. But then in 2019, we had the trade war with China. We had some business momentum was starting to slow. All the while, price kept rising. So as the price kept rising, you'll see that one more click, Brent, you have what opens up again. Mr. Alligator comes back. So one more click, you got a negative divergence. This is what the market was facing at the beginning of this year. We know alligator jaws always close. They only need trigger. But at the very least, at the beginning of this year, stocks were expensive. So one more click, we'll get out of this slide, Brent, and go to the next one. Stocks were expensive. The trigger that caused the jaw to close in 2018 was the Fed, caused a 20% decline. Fed corrected its error. Stock prices were disconnected by the divergence. But one more click, the one thing we want to see is what was the trigger that closed the jaw this time? COVID-19. Go to the next slide. COVID-19 wasn't the only trigger. That was more than a trigger because it shut down business. And what we saw, and this is where people don't realize why stocks are up 31% since March 23rd, and all the while, all the reports we're getting on the earnings front are horrible. And the reason is the market is like Wayne Gretzky. The market was anticipating these cuts. Back in February, from February 19th to March 23rd, the S&P 500 fell 34%. It was skating to where the puck was going to be because it anticipated these cuts. Even though we shut down businesses, and most businesses shut down in the middle of March, the anticipation of that and the news leaking out from that was that it was going to happen, and the market guessed it right. So you had the alligator jaw up, and you had stocks that were very expensive at the time. You had a 34% decline. So stocks never ignored these bad earnings. They're just not pricing them now. They priced them in 2 months ago. And as Kevin has done very well here, he's laid out massive amounts of fiscal stimulus. I mean, trillions and trillions of dollars of fiscal stimulus. He hasn't talked about the monetary stimulus that's out there too, that comes from the Federal Reserve. And there's trillions and trillions there too. So we got all this massive stimulus on top of this. So if you want to know why the market's up 31%, but we have all this stimulus, but to me, it doesn't mean anything. COVID-19 fears have also eased. We still have the fear, but peak fear was around mid-March. So I want to show you the next two slides. If you go to the one slide next, I'm going to show you the death rate on COVID-19 on an absolute basis. You see this death rate here. We know it's approaching over, this is from a couple of days ago, we're going to be approaching over 60,000 deaths in the United States. And it just looks like it goes parabolic. This is the curve that they want to flatten. If you go back one more, Brent, on there, that curve, it's straight up. If you're looking at that data set, it looks like it keeps getting worse, right? Because the number keeps increasing. Most people look at it this way and see that it's going. But the one thing we do at the Earnings Scout with earnings is we look at rate of change, not an absolute set. When you look at rate of change, you can actually see if the momentum is accelerating or decelerating. So go to the next slide. This is the same data set that we're looking at for the death rates in the US on COVID-19. However, it's on a rate of change basis. So the daily death rate. Do a couple more clicks here, Brent. We'll go in here. So March 23rd was the bottom in the S&P 500. Take a look at March 23rd on here. That was the peak day in terms of the rate of the increase in the death rate. So we had a 40% increase that day from the day before of deaths in the United States. Look how it has waned down to 2%. So yes, from yesterday to today, there was about a 2.5% increase in deaths in the United States, as opposed to back in March when it was 40%. So it's slowing, it's easing. So the S&P 500 has now rallied. This is from a couple of days ago, not 25%. Blinken, you missed it. We're up to 31% after tonight's close. Yeah. And so that has decelerated, that has rallied as the death rate has decelerated on a rate of change basis. Is this a coincidence? We think not. Yeah.
Nick, can I jump in real quick? Because I got a question that's talking about, well, you know, we're only off 10% roughly on the year, but we've gone from 29,000 and we're only back to 24,000. And one thing I think that we always try to reiterate to the clients is, you know, down 50% requires up 100 to break even, right? Or I always use the example in the office when I draw on the board, down 10% requires up 11.3. So yes, we've come off the lows, yes, we've bounced 30%, but we're not back to whole, and it's just math, right? We have to go up more than what we went down to get back to whole. So Steve, I hope that kind of answers your question, because the math does get funny when we look at it from that standpoint. They were only down 10%, true, but at the same token, you know, you've got to come up more than what you went down to get back to your starting point.
That's correct. A 50% drop in stock prices requires a 100% return to get back to break even. That's just math. So it's all relative, but nevertheless, is the worst over? As we look at it, you can click through these. The stock market thinks so. It's rallied over 30%. And so why is the market rallying? And as Kevin laid out, there's tons of stimulus. But to me, it's the COVID-19 fears easing, because that allows the reopening of business. And it should lead to abnormally high growth next year. And if you think about it, if COVID-19 fears are there, you can have all the stimulus in the world. If people are staying in their house, businesses don't make money when they're shut down. So if they're shut down, they lose money, the stock prices drop. This is the same thing that occurred back in 2009. And the one thing we see is, you know, the market's pricing in abnormally high growth for next year. So participate in the rally, don't be greedy. Frank did a good job of saying dollar cost average. So what we're saying is go back and get your normal allocation. So when the market gets too high, because the market's not cheap anymore, you can sell some of those to get back to normal. On days you're underweight on the sell-offs, you can add to them. But a dollar cost averaging strategy will work very well here in the allocations. And we got to watch here as we rally too far, too fast, potentially. And the market might be pricing in too much growth. We might get back to the problem we had at the beginning of this year before COVID-19 fears hit. And that was stock prices might become very expensive again.
Perfect. Thanks, Nick. I'm going to kind of bring us in here. I'm going to go to the last poll question. And this one is in regards to in 188 days, we still have an election in this country. And so I want to get kind of a take here on, do we feel COVID-19 will affect the outcome of the presidential election? And I put this in just for fun. We're not going to talk politics, I promise. Who will win the presidential election in November? And remember, it's anonymous, so don't feel like you can't answer the way you want to. I'll let this run for a couple of minutes here. And I know we're coming up on the hour, so we want to be respectful of your time. I've answered kind of some questions, but I'm going to talk about some psychology here. To us, there's kind of 4 stages as we go through this, and it is survive, adapt, recover, and evolve. And I've got most of the poll here. So do we feel COVID-19 will affect the outcome? Oh, there's a couple more coming in. I'll give it a couple seconds here. Okay, so I'm going to end the poll and share. So 80% say yes, COVID-19 will affect the outcome, and 68% believe Donald J. Trump is reelected. 32% believe the former Vice President Joe Biden is your next president. Again, we won't talk politics and go into that. I just want to put that in here to get a sample to kind of what people are thinking as we go through this, because the election will happen one way or the other. And one thing about COVID-19, we're all not being bombarded with the presidential ads that we would typically be seeing right now. We're bombarded with wine with the wine and, you know, every politician up there talking, but we're not being bombarded with the ads for president at this point. Okay, so again, respectful of your time, I'm going to talk about the psychology piece here. And survive, adapt, recover. To us, we're somewhere between adapt and recover, depending upon where you're at in this process. And the last part is evolve. I'm going to use 9/11 as an example because clients will say, well, you know, it's never going to go back to normal. And this time it's different. And when we do investment committee, and Nick's on our investment committee, we talk about how the variables always change, the outcome's the same. And we evolve as a human race, right, globally. And so I use 9/11 as the example. Pre 9/11, you would zip through an airport in less than an hour. Post 9/11, you spend 3 hours to get through an airport for a 2-hour flight to Florida and spend $15 on a hamburger. And we've been calling that normal for 19 years now. And the global air traffic since 9/11 surpasses all of the years previous 9/11 total capacity by a long shot. And so what we didn't ever believe would be normal, for 19 years, we've gone through checkdowns, x-rays, take your shoes off, you know, TSA, verified license, passports, and we've called that normal. And we're not going to try to pretend that we know exactly what normal is coming out of this, but we will evolve into a normal, you know, going forward. We're tight on time here, but this slide here that I was going to show, and let me see if it'll take us to it. Talks about the presidential and what has happened in the past. Everybody talks about if Biden were to win or if Trump is to be reelected, does it have an effect on the outcome? This chart will actually show you that it does not. And I don't know if everybody can see the screen that I switched to or not. So I'm going to come back here to here. But if you go back to the history of the last 100 years, the presidential, whether Republican or Democrat, has not had major effects on the overall markets. And we get that question often as we're going through this here. So some Q&A that was sent in before this. Could the U.S. go into a depression? Our view is that as the Fed and Secretary Treasurer have stepped in, they took that scenario off the table and have propped up markets and are continuing to do so. Secretary Treasurer just did a interview yesterday, and then Jerome Powell was on today, and they will continue to take the method of whatever it takes, and so that's why we believe we don't look at a depression scenario. Short-term and long-term effect with the massive stimulus have on stocks. Eventually, we have to deal with the debt in this country, right? We all well are aware of that. But in this crisis, every form of currency around the world ran to the U.S. dollar. And that allows us to keep the printing presses going because we are still the strongest financial powerhouse in the world. It didn't go to gold. It didn't go to Bitcoin. It didn't go to the Swiss franc. It went to the good old U.S. Treasury. And that makes the debt not as prevalent that it eventually will become, but that can has been kicked down the road. Bonds are interesting. So you've got to understand the credit risk on the bond side here and look at what you're holding, because we will get into what we call balance sheet risk. The longer this goes on, companies that have high amounts of debt will start to default. I mean, the headlines throughout the year are not going to be pretty. And every news channel, whether you're watching left, right, or center, will sell fear and sell it at a high degree to each and every person that'll listen. But you've got to understand balance sheet risk. In the portfolios we manage, we always believe in quality, and we believe what we're holding will last whether we're back to normal in a month or 6 months. Inflation's an interesting one, and we believe that on the backside of this, we may see the first form of an uptick in inflation that we haven't seen in a number of years. That's not immediate in our view. That's more of kind of midterm, but we do think a couple of years out, we could be where Nick's talking about stocks get expensive. We kind of have a view that we may get back in an overheated scenario, kind of like in '07, where prices just went up and the earnings piece was not connected at all, and real estate values tremendously climbed based on just pure optimism, not reality. Tax is going to increase. There'll be a lot of conversation around this. I'm not going to try to be to say I exactly know where that's going to be, but you do have to pay for this in some form at some point. And you do that through tax revenues. Where they come and how they come will be debated on both sides, over probably many cycles. And then we touched on the stimulus check piece. It doesn't have to be repaid, and no, it is not taxable. So let me jump here and look at the Q&A to make sure I didn't miss anything. Inflation factor recover, we touched on that. There's one tax question that I will leave for Kevin. Does the delay of payments for the employer Social Security taxes apply to self-employment taxes?
You know, there's credits available, just like there are for the payroll piece, if you use the sick leave component and the retention credit, but I don't think it really applies in the self-employment scenario. That would be really an odd application. I can see the reason for the question, though. But sure. I don't see the mechanism for that.
Okay. So I want to thank everybody for being on. We had really good attendance here, and I will commend about 98%. I did a quick calculation, actually stayed on with us for the whole hour. So glad we didn't bore you. Hopefully you got something out of it. Hopefully you enjoyed the poll questions. We're always here for you, and I want to thank Nick and Kevin for helping us out here. They did not hesitate to help us in providing information to all of you. So again, thank you. Stay safe, stay healthy, and thanks for joining us.